This is a weekly presentation of the Silicon Valley real estate market conditions for the week ending June 20th, 2025 at 11:59 p.m. These are the key chapters. These are the graphics that correspond to those chapters so you can remember which sections you like the most. The timestamps are in the YouTube description below. Here is looking at the sales for the past week. You can see that the purple line is on top of the blue line. That indicates that we've had very limited number of transactions for the past 18 months. This is on a 1 week basis. For the first data point, it's lagging by 1 day. I go from Friday to Thursday for the most recent week. And then after that, it's Saturday through Friday. This is a summary of the different micro market areas. You can see Silicon Valley at the top, then Santa Clara County in its 7 micro market areas, San Mateo County in its 6 micro market areas, and finally Alameda County in its 7 micro market areas. Micro market areas are very important. As a prime example, just look at Santa Clara County, 118% appreciation, but the largest rate of appreciation of a micro market area is 100% in the Santa Clara, Willow Glen, Cambrian, Campbell area. How can the overall be higher than any one of the components? It's simply a matter of the areas down here that are affordable are selling fewer homes relative to the homes on the higher end. There's been a micro market shift. The expensive areas are selling roughly their normal amount of number of offers. The less expensive homes are selling about 2/3 the number of offers that they typically do. That pulls up the median price because now there's a higher percentage of high-end properties. That's why micro market data is going to tell you a lot more of what's happening for a given property. A CMA is the way to know what's happening on any given property. Here now is a summary. Inventory you can see is up here on the high side. This in the middle is the current week. You can see that you're just slightly below the most inventory you'd expect. The most inventory you'd expect is over here at 3388. You're at 3275. So you got 113 less listings than the most you'd expect. Earlier this year, just from basically back 5 weeks to back 8 weeks, you were quite a bit above even the blue line. Moving down to offers accepted, these are offers that were accepted in the past 5 weeks that have either closed or have not failed out of escrow yet. You can see that that's slightly below the least number you'd expect. So the least number of offers you'd expect is 2,215. We're at 2,151. So we're selling roughly, what is that, 60 fewer listings than the least number you'd expect. So clearly there's a lack of offers. We're only at 77%, 78% of the number of offers you'd expect. Transactions are closed transactions. This is on here not as a leading indicator because it actually isn't, but just a metric of how the economy is doing. Closed transactions are what moves the economy forward. A failed transaction doesn't really add any significant value to the economy. We started off 13 weeks ago at 88% of the number of transactions you'd expect. We're now at 75%. That's right in line with the number of offers. So nothing really earth-shattering there other than there's a lack of transactions overall. Days unsold inventory is the seller-buyer balance, the supply-demand balance. We started off the quarter at only 39 days. We're now up to 53. So we've clearly slowed down significantly, 14 days. That's 2 weeks in the last 13 weeks. Your typical is 34 days. So you're basically 20 days longer than you typically are. That's almost 3 weeks longer to sell your inventory. And the slowest you'd expect is 43. So we're a week and a half longer than the slowest marketplace you'd expect to have in Silicon Valley based on the previous 10 years. So you're currently at 158%. A high number is a slower market. So you're almost 60% slower than you would expect to be. Days on marketplace, this is the time for 3 out of 4 sellers to sell. We actually started off the quarter ago at 83%. So faster marketing time than you'd expect at 15 days. We're now significantly higher. You're at 30, where you'd expect to be at 17. So you'd expect a little bit of increase at this time of the year, as you can see by the slope up of the gray line. We were at 83%, as I said, and now we're at 182%. So you're more than doubled the slowness of the marketplace. You're typically at 17 days. You're at 30. The longest you'd expect is 27. So you're taking basically a full week longer for 3 out of 4 sellers to sell their property than the slowest you'd expect. And you're almost double your 1.82% times the typical, 17 days times 1.8, so they give you 30. So you're almost twice as slow as your typical marketing time. Sellers' price reductions. This shows the seller's expectations when they went on the market compared to the market reality. Were they able to read the market correctly? Quarter back, we were looking at a 0.4% price reduction. That's less than half of 1%, but that's 70% more than of a price reduction than it typically is. So typically you're down somewhere around 20 quarter of a percent reduction. Now you're at 1.25%, and that's 83% more than it normally is. That's 184% of what it normally is. Typically, you're only taking 2/3 of a percent price reduction. Now you're taking 1.25. So that's basically somewhere in rough numbers, a little bit more than 0.5% more price reduction, which is pretty significant when you're talking about only taking a little bit more than 0.5% to begin with. Even in a soft marketplace, you're only taking a 1.1% price reduction. Now you're taking a 1.25, 1.25. Overbidding is just comparing actual raw numbers to raw numbers. So a quarter ago, we were at 8.8% overbidding, and we were typically at 6.3. So we were 2.5% more overbidding, which is why the purple line is above the gray line. Now the purple line is below the gray line by 2.7%. So you went from 2.5% above the overbidding to 2.5% below. So you've had a swing of 5% in your bidding, because the amount of overbidding normally goes up by 1.5%, and we've come down by 3.8%. And you add those together and you end up with the 5%. Here is looking at the 3 key indicators over a long time, all the way back to January 1st of 2015. The purple line is your active inventory. You can see you're about 118%. You can see we were all the way up to almost 138% of normal just a few weeks ago, and then we've come down. Which direction this will go in the future, there's no way to know. The offers accepted have been plateaued down here somewhere around 78% of the volume you would expect to have. So a shortage. It's up from where we were in 2023, but down from basically every other year. We're having close to record low years. We are having a record low if you ignore 2023. Here's the active inventory. You can see you're up here on the blue line, so you have almost as much inventory as you'd absolutely expect. It looks like we've leveled off, which is what the blue line typically does. So that would be my expectation, that your inventory levels are not going to change dramatically from week to week going forward. This is on a percentage basis. You can see we're now about 18% more inventory than you'd expect. So 118% of the normal level of inventory. The only time we were higher than that was back here at the end of 2018 and beginning part of 2019. Other than that, we're normally driven by a shortage of inventory. Offers accepted over the past 5 weeks. You can see we've been at the blue line ever since halfway through 2022. So that's 2022, 2023, 2024. So 3 full years, 36 months of having very limited number of offers accepted, basically following the least number that you would expect. This is on a percentage basis. You can see basically from here over, we've been basically at this record low numbers. You can see the rush after the pandemic. You can see the normal level of sales prior to the pandemic, and then you can see the impact of the pandemic itself. This is days of unsold inventory, the turnover rate of the marketplace. If you look at this, you're significantly above the blue line, and we improved the last couple of weeks, but now we turned around and went back up. Which direction this is going to go going forward, I would expect it to be flat to going up a little bit. Basically, I'd expect it to sort of follow the blue trend line down here, and clearly that's up until the end of third quarter. So I'd expect another quarter of upward pressure, but I don't expect it to go up too much, because we're already at record high territories, except for very brief moments of time, mostly right at the end of the year. So to be in the middle of your selling season and to be at this high level is pretty unusual. Here's on a percentage basis. You can see that we're at record high on the turnover rate compared to normal. This is where you compare the actual data to the 10-year median for each week. Here's your marketing time for 3/4 of the sellers. You can see it turned halfway through first quarter, which is right around Valentine's Day of 2025. And you can see that it's been climbing straight up ever since. No let up in sight. And I would expect that number to continue to go forward based on just the makeup of the data point. Here's on a percentage basis. Just last week, this graph capped out at 70% on this vertical scale over here, 170% on the Y scale. And now I had to extend it out to 200%. You can see we're at record high territory. We're even equal to the peak of the pandemic. This got shifted over sideways. I'll try to correct that for next week. But I will have a caveat back here. The actual days of market here was probably greater than reflected in the data. And that's because the MLS made a decision to not count days on market when you weren't able to show properties. So there was about I don't know what it was, March 20th through about May, maybe even May 20th. So about a 60-day period of time when they weren't advancing the days on market. So this number would have been actually higher. They did that to encourage sellers to go forward and market their properties. Here's the sellers taking the largest 90 percentile seller. It's taking the largest price reduction. How much of a price reduction there are they taking? And I like this number myself. And you're down here at 87.5%. So the aggressive seller that's doing the biggest price reductions is reducing their price 12.5%. Here's on a percentage basis. You can see that that's 130% of normal. So almost 30% more of a price reduction than it typically is. So you can see it's pretty significant. Here's the average. This is where you put in everybody in a blender and just what is the average. And you can see you're just right at the blue level. And that's only about a 1.25% price reduction. So about 1.25% price reduction. This is on a percentage basis. You can see we were significantly higher just a few weeks back. We're climbing up, probably not that the market's getting better, but this is the time of the year where you start seeing more price reductions typically. So it's a lower percentage. Here's the frequency. So how common is it? And we're still less than 1 in 5 sellers reducing their price, 20%. But if you look back, that's relatively the high peak points, except for when the market was doing something very unusual. So 20% of the sellers doing a price reductions may not sound like a lot, but it is significant. It also looks like it's going to continue to go up because the blue line goes up at this time of the year, and there's been no variation. It's been straight up since the beginning of second quarter. You may even be able to argue that it's been straight up since the beginning, halfway through first quarter. Here's on a percentage basis. You can see we're near record territories. There are a few period of times when it was higher, most notably in 2022, right after the market correction that we had. Look at the huge slowdown. We've gone through a huge slowdown, and now you're sort of doing a price correction. Will this go down and then bounce back up and then come back down again? This is sort of the area where I'd expect it to be. So basically sort of flat with some variations in it. Here's the median overbidding. Earlier we looked at the average overbid. The median is the midpoint. So half the buyers are overbidding by more than 2%, half are overbidding by less than 2%. But to be having even a 2% overbid is still significant. The average overbid, I think, was about 5.5%, maybe 6.5%. This is now just raw count. So here's where you have the exact normal overbidding for the given week. So right now we're about 3%, 2.5% to 3% below the amount of overbidding that you would expect for this particular week. I believe the number for this particular week was 2%. So the typical overbidding, if call it 3% less than typical, that means the typical overbidding would be about 5%. Here now is the frequency of that overbidding, and you can see that more than 60% of the sellers, somewhere around 63% of the sellers are getting more than their asking price. So no longer, it's now under 2/3 of the sellers, but it's still a fairly significant percentage of the transactions that get above the seller's ask price. Here's on a percentage basis, so you can see the frequency of overbidding is now only 85% of where you'd expect it to be for this time of the year. Here's a pricing model. There's two different models on here. One is a straight 11.4% price increase for the last 10 and a half years. The other model says that we went up 12.5% for 7 years and then 3.33% for the last 3.5 years. I think what's probably more accurate is something higher, a little bit higher than 12%, but not much. But then basically flattening the last 3.5 years completely off and saying there's been no price change at all. Here now is the marketing time in a distribution. So each line on this graph represents a different week. The purple line is the current week. The dotted line is a year ago. So compared to last year, you can see that marketing time is significantly longer. Let's step up, and what you're going to do is watch the dotted lines. I expect them to start increasing, which is longer, slower marketing time. They're increasing slowly. So that's where I'd expect the purple line to do, because basically I expect this year to repeat last year unless there's something unusual. You can see that it's been basically not moving very much over the summer. Then it starts moving up right there around Thanksgiving. There's the peak. So you can see that December 27th out of the week shown is the peak. Then it started rapidly improving. Also notice when you're at the improving, the top end here above 85% gets very steep. That's because now every once in a while you sell one of those homes that's been on the market for a long time because the market's caught up to it. And then once the market starts slowing down, that flattens out really rapidly. So it's only during steep improvements that upper end gets steep like that. Now you're just coming up in recent weeks. That's last week and that's this week. So we've been slowing down. We're not at the longest marketing time, well, but we're at the upper end. So marketing time is clearly some of the longest out of the last 52 weeks. Same concept now with price reductions. The purple line is the current week. The dotted line is where we were a year ago. Let's step through. You can see the market bounced around, but basically it's cooling in direction. So that means I would expect the purple line to cool and bounce around the level it's at now for several weeks. As you can still see there really hasn't been much movement from where we started off. And there's a big reduction. And there's the slowest it was for the year, and that's December 13th. Keep in mind, I only have every other week. Then by December 27th, it was already improving, and we're rapidly approaching this best time, the least amount of price reductions. So here you were on February 21st, again, only every other week data. And then you start taking larger and larger price reductions, and you rapidly come up to the solid lines, which are the recent lines. And pretty soon that's 2 weeks ago, last week, and the current week. So the current week is the lowest on the line and also getting to be some of the lowest lines out of the last 52. And then the third and final distribution showing the same thing on buyer overbidding. Here you are on the purple line, which is a fairly cool marketplace, one of the least amount of overbidding. A year ago, you were up here one of the most. So basically it says that the overbidding has basically been cooling off this whole last year. Here's the actual data stepping through, not much change. Now it's cooling off a little bit there right in the summer. That's coming off the spring run up. Now you're in the summer doldrums where there's no real significant movement. And now you're getting up to Thanksgiving time frame, and that's where you're going to start seeing some movement right there, right there, right there. And that's the worst week, which is the January 24th. Keep in mind that this is closed data, so the bottom of the marketplace happened around December 20th, which is probably earlier than you would intuitively think of it would be, and it may actually be January 3rd if instead of a 5-week delay, it's only a 3-week delay. It also could be something as simple as the delay, the bottom of the market is places on the week not shown here, January 31st, and a 4-week delay, which is actually probably pretty close to what it is. Moving on, you can see the market then rapidly gets more overbidding. There's the peak of the marketplace on March 22nd. And again, if you say that there's a 4-week lag time, that takes you back to February 22nd. And then you start coming back down fairly quickly. And that's this year. And now you're leading up to the current week. That's last week, and that's this week. So this week is one of the slowest amounts of overbidding on the whole graph out of the last 52 weeks. Here now is the active inventory by the 3 counties. Alameda County's got the most inventory and almost normal inventory. Santa Clara County is the next, and close to its normal level, but clearly Alameda's closer. And then San Mateo County, note it's above 600, which has never been crossed except for this year. So we have a record high level of inventory in San Mateo County. Here's offers accepted. You can see it's rolled over in all three counties. The least rollover in San Mateo County, probably followed by Santa Clara County, and Alameda County has had the most rollover in the number of offers accepted. Here's days on sold inventory. So the turnover rate of the marketplace, the slowest market turnover is Alameda County, then San Mateo County, and the fastest turnover rate is here in Santa Clara County at about 47.5 days, 47 days. Here's the marketing time for the three, and it's in the same order. Santa Clara County is the fastest at something like 26 days, San Mateo County at 30, and Alameda County just shy of 34 days. But even 34 days to sell 3 out of 4 sellers is really not bad. Here's the magnitude of price reductions. So Santa Clara County has the least amount of price reductions. San Mateo County has the next most, pretty close together. And the most at almost 1.5% price reduction is Alameda County, 1.4%. Here's the frequency. Alameda County has the most frequent amount of overbidding at 22%, followed by Santa Clara and San Mateo, essentially tied at 18% of the sellers are reducing their prices. Here now is the amount of overbidding. You can see that they've all been declining, and it's interesting that Alameda County had the most price reductions and the longest marketing time, but it has the most overbidding. I suspect strongly what's happening is sellers are coming on the market, aren't successful in selling, are reducing their asking price, overshooting where the buyers are, and therefore the buyers then feel the pressure and competitiveness, even though it's been on the market for a long time, to overbid the now reduced price. Santa Clara County and San Mateo County are very close together at 4% overbids. And that's average. The median, I think, was about 2%. Here's the frequency of overbidding, basically all in the low 60s, anywhere from 62% to 64% for all three counties. All three counties are going downwards, so the amount of overbidding is decreasing fairly significantly. And this is long-term appreciation. Santa Clara County is up here at 118% appreciation. Then you have San Mateo and Alameda County basically tied at 181% appreciation, which is actually 81% appreciation from the last 9 months of 2015. I already made the comment in Santa Clara County, the 118% appreciation is an overstatement because there's clearly a drop off in number of transactions at the low end of the marketplace. And if all of a sudden you're selling fewer low end homes than you typically do, that raises your median price, even though it doesn't impact property values. Here's your sold price on log paper. Santa Clara County and San Mateo County are very close together. I think in the next slide, you'll see Santa Clara County is a tad lower and Alameda County is the more affordable. Only Santa Clara County is above its previous 2022 price peak. Here's where you can see that the blue line appears to be fully underneath the orange line, or the orange line is above by just a little bit. And so the two prices are essentially equal, with Santa Clara County being a few $1,000s less expensive. And basically, San Mateo County is below its previous peak. Santa Clara County is above. But again, I think that's not market value. I think that's because of the current drop off in low end properties in Santa Clara County, artificially raising the median sold price because of the shift in market mix. And Alameda County, like San Mateo County, is below its previous 2022 peak. Here's the estimated payments using the Freddie Mac national high balance conforming interest rates. If you do a jumbo loan, which you can pretty much do for almost any single family home in Santa Clara County, that drops the interest rate by about 0.5%. And then if you have any money in the stock market and you're willing to have your mortgage company hold your stocks, then you can usually get, or other assets, you can usually get even more attractive interest rates. So these would be a high estimate of payments. Now we're moving on to micro-market data. Micro-market data is important because it gives you a better idea of what's happening to any individual property values. The CMA is obviously the best way to do competitive market analysis, but micro-market area is a quick second place. Here's offers accepted. You can see Morgan Hill, Gilroy really missing out on the offers at only 50%. So half the offers in South County, the affordable areas in Santa Clara County are at 70%. Milpitas is at 72, Campbell 77. And then you start getting up into your more expensive areas, Cupertino at 100%, Saratoga, Los Gatos at 70. So that's on par with the cheaper homes. And then Los Altos at 112. So it's my contention that this 100 and 112% compared to most of these numbers, somewhere around 65%, is why the median price in Santa Clara County has gone up. It's not property values because of the shift in the market. Here now is days on unsold inventory compared to the 10-year median. So again, what this is saying is across the board, almost the one exception is right here, Cupertino, Sunnyvale, but across the board, when you look at the turnover rate of the marketplace today compared to the 10-year median, it's slower now, taking longer periods of time to turn over than it did over the past 10 years. Here's marketing time. This is the time it takes 3/4 of the sellers to sell their property. You can see the amount of blue everywhere, and this is compared to normal. Yes, it's taking 2.5 times longer than normal to sell their property, but we'll see in a second that it's still fast. Here's price reductions. Now, this is interesting. Your expensive areas, Los Altos, Palo Alto, and Saratoga, Los Gatos, are actually taking less price reductions than they normally do. And then your other areas are taking quite a bit more price reductions than they normally do. Here's the frequency of those price reductions. So it's still very infrequent, except for in Los Altos, Palo Alto area over here in Saratoga, in Santa Clara County. The center part of Santa Clara County is right about normal. And then the affordable areas is seeing more frequent seller price reductions. Here's days on sold inventory. This is raw count. So this is just how quick the market's going. So earlier we saw that it was pretty blue when we compared to the 10-year median. Now that you're just looking at the turnover rate itself, it's actually fairly balanced to even maybe favoring the sellers. What's that really saying? It's saying that typically we're driving a race car 120 miles an hour down the racetrack, and now instead of doing 120, we're still going 80. So it's still fast, but it's not as fast as we normally are going. And that's essentially where the story. Here's your time to market, 3 out of 4 sellers, still basically balanced, or in some cases favoring the seller. The only one that's favoring the buyer is the San Mateo County coast, where it's taking 2 months to sell 3/4 of the properties. But again, to be complaining about taking 2 months to sell 3 out of 4 homes, that really is going to be fast paced compared to anywhere else. In fact, I was at a meeting where they did a quick summary of California-wide data, and right now your marketing time, as measured by days of unsold inventory, was 118 days. We're nowhere near 118 days. Here's the ask price adjustments the sellers are doing, and they're going down. They're going down about 1.5%. It looks like overall, maybe 1.4, something of that order, but fairly neutral with a bit of a hint to the buyer. So a little more common to have price adjustments now than normal. Here's the frequency of those price adjustments. So again, still fairly infrequent. I'm not seeing very many numbers. I'm seeing Pleasant in at 40%, but that's by far the highest. Everybody else sort of maxes out at around 25% of the market, 1 in 4 of the sellers doing a price reduction. And this is buyers overbidding. What are buyers doing when they come in to actually buy the property? You can see it's still fairly significantly overbid. And that means that they're paying, in order to be pink at all, it has to be at least 1.5% above the seller's ask price. Unless you're dramatically underpricing your property, and if you're going anywhere near market value, which I think is what most people try to do, maybe a little bit on the low side, to have overbidding is pretty impressive. And we don't have a shortage of that in Santa Clara County, overbidding that is. Here now is the buyer frequency of overbidding. You can still see that somewhere around 60%, a little over 60% in all 3 counties are getting more than their asking price. So 6 out of 10, 3 out of 5 sellers are getting more than their asking price. Again, you really can't complain. Appreciation, here again, you can see the 118% on a county-wide basis, but the highest individual micro market area is 100%. So clearly and based on the other data, there's fewer inexpensive homes selling, a few more expensive homes selling, causing the appreciation to go up greater than property values. Mateo County is more reasonable indication of property values because you got 130 and you got a 55, 85, and their overall appreciation is 82. Same with Alameda County, their overall is 83, and you got basically a 45 and a 58, but you got a 97 and 81 and 93 and 84 and an 88. So it's only Santa Clara County that's clearly had a shift in the market makeup. Here's your sold price, and instead of following the median number, which is the middle number, I also add in the 10 percentile and the 90 percentile so that you have a price range in each one of the micro market areas. Here, you're not seeing anything other than the red areas are the expensive areas. The blue areas are sort of the outlying, less expensive areas. Here's a summary chart of the data. The first green ones here are that year to year to comparison. And it's not year to year, it's current year to the previous 10-year median. And then the yellow is your actual raw numbers. So this is saying that Silicon Valley is moving slower than it typically is. It's a more buyer-friendly marketplace than it typically is for this time of the year. But even though it's more buyer-friendly than it typically is, when you start looking at the raw numbers, it actually still favors the seller. Here's the volume of transactions. The big takeaway is we're having the second worst year out of the last 10 years, and also the second worst years out of the last 25. The only year that was worse than the current year is 2023 after the 2022 price correction. A lot of the reasons we improved in through here was the pandemic. You can see that the year 2020 had the lowest number of transactions, which is why I have the crossouts. It's not that the data is inaccurate, but it's noteworthy that those are where the COVID impact was. Here's your raw numbers for Silicon Valley, Santa Clara County, San Mateo, or Alameda County individually. You can come down and pick out whatever metric is the most interesting. I will point out the number of new listings is down significantly this week over last week, and 80% of the data is the same. So what it's really saying is the number of new listings the past 7 days compared to the number of new listings 5 weeks ago is significantly lower in the current time frame. We have been talking about the Silicon Valley real estate marketplace. We will be going on and talking about the Greater Bay Area, 13 counties and 5 regions. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers in single agency transactions. The blue URL is for the YouTube archives of these presentations. You can also get there by typing in the shorter green root URL. If you add in the 2025 to the green root URL, then you get to the live presentation Saturday morning at 9 a.m. The handout was up before the meeting started. Green root URL plus the letter H for handout, 2025, 06 for the month, and 21 for the date of the presentation. Then if you want a specific episode and want to go right there, you can type in the green root URL, the year, month, date of the Saturday presentation you want. I appreciate subscriptions if you're not already a subscriber, and likes, and any feedback on how to make the presentation better or more user-friendly for you or more useful. Moving on to the Greater Bay Area, here are the 5 regions we're going to cover. We've been focused up to this point on Silicon Valley. We're going to add in the cities, San Francisco and Marin, the North Bay, 4 counties, the Central Valley, San Joaquin and Sacramento, and the Central Coast, Santa Cruz and Monterey. Here now is looking at inventory in all the regions. It's going up or flat. It's flat in Silicon Valley. I would say it's flat in Silicon Valley and it's flat in the cities, sort of the job center meccas. The other 3 counties are all still increasing the number of active inventory. Here's the number of offers clearly rolled over in Santa Clara County. Looks like we're flat in every other area just in the last week or 2 at most. So it looks like there's been a shift in the number of offers in the negative direction at the time of the year where you sort of expect offers to still be strong. Although I will make a mention that the typical peak of the number of offers is the 5 weeks before Memorial Day. So that would be the month of May. And so the fact that we're leveling off really isn't unusual because we start going down fairly soon after. We don't have a big decrease, and you can go back and look at history, but you can see that we start going down midway through second quarter and continue that downward trend. Where it really breaks off is midway through fourth quarter. Here's your days of unsold inventory, basically, higher than you typically are. Like look at Santa Clara County in the purple. Right now, if you drew a line back at 58 day or 55 days, you'd be up here and you only have very small spikes where you had a slower marketplace. Cities is similarly, you're close to the record high numbers. The yellow is Central Valley. It again is also very close, except for the end of the year spikes. And then the gray is a little harder to say, but that's North Bay. It looks higher. And then finally, Santa Cruz is easy because it's on the top and basically it's at the highest level it's been, except for small peaks. Here's the marketing time based on how long does it take 3 out of 4 sellers to sell. You can see it's going up in all areas. I would expect this number to continue to go up. Santa Cruz did have a little correction, but that's more just, what happened that particular week. Here's the greater Bay Area price reductions. This is with prices the seller adjusts downwards to attract the buyer in to get the offer. You can see that Silicon Valley has the least amount of price reductions, followed by the city and Central Valley very close together. And then you have the North Bay and the Central Coast somewhere around 2.5%, 2.25% price reductions. Here's the frequency of price reductions. So most frequent price reductions are happening in Central Valley at about 37%, I would guess that is, followed by North Bay at 33%, Central Coast at 30%. Cities has gone up dramatically, right now at 28%, and doing the best is Silicon Valley at roughly 20% of the sellers doing price reductions. And 20% is only 1 in 5 sellers doing a price reductions. Here's the amount of overbidding. 2 counties are below Central Valley and Central Coast. Buyers are coming in below the seller's ask price typically or on average. In North Bay, they're coming in about 1% over ask price. Silicon Valley is about 1.5% over or 5% over ask price. And then finally, the cities is 7% over ask price. Here's the frequency of that overbidding. The most frequent is in the cities at about 71%. Silicon Valley is at 70%. Then you move down to the North Bay and you're down at around 44%. Central Valley is at 36%. And finally, the Central Coast is at 30%. Here's the long-term appreciation. You can see the cities has really fallen off and has done the least well. I've already commented that the 118% appreciation for Silicon Valley is artificially high because of the shift in market mix. The same thing could be happening in Santa Cruz. Central Valley has had a significant increase because it's become a more popular destination post-COVID with more remote, more flexible work hours and days. And then the North Bay at about 73% appreciation. Here's the median sold price. You can see the cities is the most expensive area, followed by the Silicon Valley, followed by Central Valley, followed by North Bay, and finally the Central Valley. This is the monthly payments for the 5 regions. It goes through a mathematical formula using the Freddie Mac high balance conforming loan limit for the nation, which is 6.81% for this week. The most affordable area is the Central Valley. The least affordable is the cities. This is going to be in the same order as pricing. And with that, we now look at the table for the 5 regions. This has all 13 counties in all 5 regions. I also have the Bay Area in here. I dislike the Bay Area data. I'm putting it in here only because the media talks about it quite a bit. You have the noun column is the current raw count. how that changed on a percentage basis from last week and how it changed from 5 weeks. So you have inventory for Silicon Valley. Let's do it. You went up 0.8% over what it was a week ago, but you're down 1.1% from over the 5 weeks back. Here's the charts, the chapters that we talked about. Here's a brief description of them, the graphical visualization, the timestamps are in the YouTube channels. Not seeing any unmuted mics. Thanks for joining. Have a great week. Thanks, care. Bye for now.